Hello and welcome to this week's episode of Nucleus Investment Insights. Today we ask the question, is a recession inevitable? We're going to take a US-centric look at the unfolding economic events that could lead Australia and the world to this outcome. We'll examine the US debt ceiling, the credit crunch, inflation, and then we'll talk about how to position yourself in this market. Today, as always, we have Damien Klassen, Nucleus Wealth's co-founder and chief investment officer. Damo, welcome.
Hi, Sam.
We'd also like to welcome a special guest all the way from the US. Peter Boockvar is the chief investment officer of Bleakley Financial Group and the author of the book report. Peter, welcome.
Thanks for having me.
Great to have you here. My name's Sam Kerr. I'm the senior financial advisor at Nucleus Wealth. Just a reminder, the information in this podcast is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at www.nucleuswealth.com/contact, and you can book a call with me to have a no obligation chat. We are usually live every Thursday at 12:30 Australian Eastern Time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind and we'll do our best to answer them during the show. Today is a pre-record because of the time difference between the US. You can also follow us on your preferred podcast platform and our show is available on all the majors. That's all the formalities out of the way. So Damo, I'll hand over to you to give us an introduction and get the ball rolling.
Thanks. So, we've been speaking a lot about credit crunch and inflation, company profits, and that's all topics which our guest today is expert on as well. And so, I wanted to get a sort of a different view or an alternate view in which I think we match on a number of things, but sort of probe into what the differences are. Probably thought I should start with the big one. I think for us, the key thing we're really watching at the moment is the credit crunch and signs that that's intensifying. We sort of look upon that as being the major investment theme that we need to worry about. A disaster, I suppose, on the debt ceiling. Maybe if I can hand over to you and your thoughts, I guess, maybe we'll start with the first one, the debt ceiling, whether you think there's a potential for disaster there and your thoughts, and then moving into, your thoughts on the credit crunch or what signs you're seeing that's starting to intensify.
Well, the debt ceiling is just a circus at this point. It's never not been raised. And what's the point of having it if it's continuously raised? So there's certainly tough rhetoric on either side, and you hear catastrophe and calamity and blah, blah, blah a lot. But it'll get raised just as it always does. And to me, it's only relevant if there's maybe a day or two of disruption in terms of treasuries getting redeemed, or I should say paid back. But outside of that, I expect a deal. I don't know whether it's within a day or two or not, but it will likely come before. Actually, it'll probably come close to June 1st, which is the date that's been thrown around as the so-called X date. And then we'll have the same debate in a year or two. And then we can go back to focusing on, like you said, the credit crunch, which the way that I look at least the US economy is sort of in two parts this year. One was before the bank failures in the US and post-bank failures in the US. And call it SVB, Silicon Valley Bank, being the first one around that weekend of March 10th, 11th. A lot of companies that I follow, that we own stock in, that I listen to earnings calls, there were definitely, for at least some of them, clear differentiation between economic activity before middle of March and after the middle of March. And then we also look at a lot of the loan data that is clearly reflecting a credit tightening that's going on. Commercial and industrial loans outstanding in the U.S. has fallen to the lowest levels since last October. We know banks in the U.S. are no longer, and I say that broadly speaking, giving out any real estate loans. In fact, they're all trying to shrink their loan books. So this is going to intensify as the year progresses. And
actually, sorry,
equivalent.
On the lending, is it when you say real estate, is that mainly commercial, or you think that's broader based than that?
It's commercial.
Yeah.
Now,
Okay.
if you want to get a mortgage to buy a home in the U.S., you'll get one, but you're going to pay a much higher rate. When you think about a loan on a house, you have that collateral. So there is something there. Now, of course, in 07, 08, that collateral dropped and there was too much leverage. But while maybe it's a bit harder to get a residential mortgage right now, it's much easier than trying to get a loan in commercial real estate.
Yes. Sorry. Yep. Keep going on the credit crunch. Sorry.
No. So it's the Fed has even speculated it's the equivalent of a few more rate hikes, and some economists have thrown out that the credit tightening that's going on, the credit crunch we're in the midst of and just beginning of, is the equivalent of 25 to up to 75 basis points worth of rate hikes. So when you think about post SVB, the Fed has raised rates twice for a total of 50 basis points, in addition to throw in, call it 50 basis points of the equivalent of monetary tightening with the credit challenge right now. And we've had basically 100 basis points of rate increases after that bank failure. So this is not good. And the overall issue for the economy, and it's not just in the US, it's everywhere, where you've had just such a long period of time of essentially zero interest rates, and then you go vertical in 1 year. That's an interest rate shock, because when you think about it, in the US, we have a 30-year mortgage. Outside of that, most credit is extended 1, 2, 3, maybe 5, 10 years. So every month that goes by from here, every quarter that progresses, somebody's loan, whether it's a household or a business, somebody's loan is coming due, and it's going to have to be refinanced at an interest rate that is going to be much higher than the rate on the loan that's coming due. So that itself is a persistent, constant form of tightening. So you don't need interest rates to go up any further from here. They just need to stay where they are, and that's a continued form of monthly tightening for the reason just stated.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
And in terms of the credit crunch, there's, I guess, what are the key signs, or what's the key data you're looking at to sort of confirm that, so it's obviously been a shock in initial terms to the data that we can see. Having said that, I guess there's a lot of data is obviously delayed and it's hard to see the data. But so what are you really looking at to confirm that yes, this credit crunch is still happening versus what sort of wild event could see, I guess, a change and the credit reopening in your view? So what are the signals you're watching?
Well, every Friday in the U.S. after the market closes, the Fed releases the weekly bank loan data that reflects the loans outstanding in commercial, industrial, real estate development, credit cards, auto loans. So in a pretty timely fashion, you can see the extent of sort of the loan books and whether they're rising or increasing in those individual securities. And in terms of credit standards, unfortunately, we have to wait every 4 months for the senior loan officer survey that will measure credits, whether loan standards are tightening, whether they're easing, whether the demand for credit is increasing or decreasing. I know the European Central Bank has a similar metric that they come out with every once in a while. I'm sure the RBA does as well. Now, we have to also make some distinctions here. In the U.S., about 20% of the credit that's extended comes from the banking sector, compared to in Europe, it's about 80%. So there's a much less of a reliance in the U.S. on banks, whereas non-banks in the capital markets fill in the rest of that gap. The problem, though, is that small companies, small businesses, are very reliant on those small and medium regional banks. So they're the ones that get hurt the most when you have this type of credit crunch. But it still filters into other things, because if you went to a non-bank lender, tried to get a loan because you had a multifamily real estate loan coming due this year, or you're a business that wanted to take a loan, yeah, you can go to the non-bank a lender, but they're going to charge you double-digit interest rates. So while maybe the supply of credit is there, it's at a very punitive rate. So even there's sort of a crunch, because not many businesses can afford to pay that level of interest rates. And in the capital markets, if you're a high quality borrower, yeah, you can probably get a loan. You can term out your existing maturities, but below that, it's getting more difficult.
And in terms of, typically, when you hit, sorry, I guess how am I putting this? We went through this period where not a lot of companies went broke for a long time, and it seems as if in most countries it's really hooked up, and it's sort of hitting sort of average levels at the moment. Are you? I guess, is that a sign you're watching, or is that sort of too delayed in terms of its output for you to sort of keep an eye on that? And I guess, where are you seeing that company bankruptcies and liquidations? Where how bad of a cycle do you think this one's going to be?
I think it could be pretty rough. I gave the example of the interest rates going vertical. So it's you have to believe going into 2022. I can't imagine many businesses were budgeting assuming that company had floating rate debt, a 400 to 500 basis point increase in interest rates, and what that would mean for their interest expense. There are a lot of people, even in commercial real estate, or even if you're Silicon Valley Bank, you just assume that rates would stay low for a while. And we know that easy money, zero rates, QE, kept a lot of companies alive that didn't deserve to be. And that the only reason why they stayed alive is not because their cash flows were able to service their debt, but because there was always someone willing to refinance any upcoming maturities. Now it's obviously much more difficult to do that. So you could have, you're going to have certainly bad business models that get exposed in this environment that were never going to make it anyway, and were only kept alive because of easy credit markets, but that no longer exists. But you're going to have, unfortunately, good businesses, or even good, call it real estate projects, that just have bad balance sheets, and maybe those businesses can stay alive, but there's going to be a different capital structure and debt for equity swaps, and so there is a lot more that we have to work through and digest in this sort of new interest rate world. And that's what it is. It's a new interest rate world where, because I think inflation is going to remain sticky for longer and more persistent, albeit at lower levels than we are now, a higher interest rate environment sort of chips away at economic growth as the months and quarters progress, because more money is allocated to interest expense, and other businesses just can't make it.
And so in terms of that sticky inflation, if we're looking at a credit crunch and a recession, I guess typically that would mean that the inflation would disappear, for at least for a short period, and maybe reappear on the other side of it. Are you expecting the inflation to stay high, even if there is sort of into quite a severe credit crunch and recession?
So it is possible to still have elevated inflation in that kind of economic backdrop. The question for inflation is, and we are talking about goods prices and services, to not necessarily look at it homogeneously, but understand that the two parts have their own dynamics, is that, yeah, we've had the spike in inflation, we're going to see we're seeing the backside of it now. But the question is where does it settle out at? In the US, we could see 2 to 3% inflation by the end of the year, but is that a victory? Well, if before COVID, we had this inflation trend that we got so used to of 1 to 2% that allowed central banks to do whatever they wished, QE, low rates, and so on. Well, what if we just settle out at like 3 to 4, and that maybe things have changed structurally, and that we're not just going to go back to 1 to 2? And I'm in that camp. I think 3 to 4 is going to be the new inflation normal, at least in the U.S., because of higher labor costs than pre-COVID. No more low labor costs out of China, and they obviously produce a lot of things for the rest of the world. Just-in-time inventory that's dead, and perpetual non-transitory services inflation, combined with, I think, more elevated goods inflation, is going to lead to less inflation than now, but structurally higher, which will also mean structurally higher interest rates, and still a lot of ways to go in working through this sort of debt repricing.
And in terms of the inflation, so is this a corporate margin thing? I guess where I'm getting from with inflation, I sort of look at most commodity prices of over the last 12 months the last 6 months have been falling. China's sort of got its PPI is in deflation and sort of struggling with low inflation over there itself. So it's not exporting sort of massive amounts of inflation. It's sort of exporting deflation, if anything. If you look at, from the commodity side, if you look at things like the UN food price index, that's all pretty much falling across everything. But on the flip side, we've still got prices, at the shelf, as you said, and what people are paying for at the counter. So where do you see the and actually, sorry, to go once the sort of 2 steps further, is we obviously went through this massive transport cost, which is still just filtering off as well. That's companies are obviously still companies that locked in longer rates, still paying for high shipping costs, but that seems to be back to normal. Packaging costs went through that same bit, and it sort of seems to be in deflation now as well. So I guess it's sort of like all the upstream stuff seems like it's sort of come back. Is it sort of wages and company profits that you think are going to keep that next cost bit, or is there something else that's sort of driving that sort of intermediate inflation, I suppose?
So in the US, in the 20 years leading into COVID, services inflation ex energy averaged 2.8% a year. And a lot of that had to do with higher rents, education prices, healthcare costs, insurance, going to a baseball game, going to a concert. There was nothing ever transitory about services inflation. Core goods inflation in those 20 years averaged 0. And you net out the two of them, and then you have the volatility of food and energy prices, and that's how you got 1 to 2% on average inflation. So you can have 3 to 4% inflation in the aggregate if goods prices rise just 1 to 2%, and then maybe services inflation goes up 3 to 4% or 4 to 5%, and get sort of 3 to 4% type aggregate inflation. So you don't need, so yes, on goods prices, for the reasons you stated, we're seeing the downside of it. But that's not the question. The question is where does it settle out at? Because when you think about outside of services inflation, goods inflation is typically cyclical. And a lot of it has to do with technology, which is always a deflationary force. And that's what makes goods sort of deflation more structural, because the more efficient you are, technology, faster production, and so on, is typically a drag on prices, but you get these cyclical bursts of inflation that we saw. So after things settle out, where does inflation go? And I think it's going to be 3 to 4, because rental prices, which are a big part of US CPI, it's actually 30% of headline, 40% of core. We're seeing deceleration in rental price increases. There's a lot of multifamily apartment supply that's coming online that's going to lead to even slower apartment growth in terms of rents as the year progresses, and maybe into next year. But there is no more multifamily apartment construction, new construction that's happening now. Because there's pencils down on a lot of deals, because rent growth is slowing and occupancy are slipping. You can't get financing. So after this downturn in rental growth, well, it's going to go right back up again because we're going to go through the next couple of years of almost no supply. So I just think that the salad days of 1 to 2% inflation is gone for a while.
On the just in time versus just in case as well, I guess this is one that fascinates me in that, and what I'm talking about for listeners is that, the idea is that companies used to operate their supply chains on a very lean model, just everything arrives just in time. And the idea is they're moving to a just in case, which is I need to have lots more in case we hit pandemics and things like that. I guess I wonder that, I don't know, let's take a car companies, and I go, there's, 5 or 6 of them decide that we're going to run a just in case, and we're going to have our supply lines, really big and long, and lots more storage for in case anything goes wrong. And a couple of the other ones decide, you know what, stuff it. It was a once in a century event. I'm going to run a much lower cost model, and I'll go back to just in case, and I'll assume that there probably won't be another pandemic, and if there is one in 50 years, well, that's somebody else's problem, not my problem. And I can, in the meantime, I can be lower cost. I don't know. I guess I'm just interested in your thoughts about how much is lip service companies are making, and how much. But when the push comes to shove, whether they'll go, oh well, I'll go with a lower cost and stay in business.
Yeah, I mean, I guess it'll depend on the business, but just from a prudence standpoint, do you really, and you're making things and you're reliant on other suppliers, do you really want to just roll the dice that you won't have any supply disruptions again for another 100 years? What happens if there's an issue with China and Taiwan? Well, that's going to cause huge disruptions. So I just don't think that from a planning standpoint, it's even worth sort of experimenting again with what the world looked like.
I agree morally.
Yeah. So I just think that you'll just have a bit more inventory, but a lot of this it makes a difference on the margin, and the more inventory you have, the less inventory turns you have, the more working capital gets tied up, the less cash flow you have, the more stickiness there is to prices. So I do think that while we're not going sort of all the way where a lot of companies use autos, for example, are going to be vertically integrated all of a sudden, they're going to create their own supply chains in-house again. I mean, you have these auto companies that are owning now lithium fields because they don't want to mess around with the supply of lithium and cobalt. So there's still a mentality that some of these companies need more control over their supply chains.
Yes. Yep. And obviously there's costs involved to that. In terms of timing for a lot of this, so I guess how do you see, is this sort of playing out over the rest of this 2023, or is this more a 2024 story? What's your sort of thoughts
in terms of
the credit crunch and actually coming to companies starting to go broke en masse and sort of recession, and the Fed starting to deciding that, hey, actually we've succeeded. Yeah.
I mean, I think it's going to continue well into 2024 on the assumption that interest rates are going to stay higher for a while. They may be lower than they are now. I would not be surprised if the Fed is cutting interest rates by the end of the year and will continue to next year. But the days of going back to zero interest rates, I just think are just not going to happen again. So even the Fed, call it cutting from 5% to 3%, or even you look at the ECB, which is still hiking, and the BOE is still going to be hiking. Maybe the RBA is done, but they're not cutting back to zero anytime soon. That, like I said, there's just so much debt that's going to be continuously repricing at much higher interest rates that this could drag on. And the world, when I say the world, those areas of the world that are over indebted, we need more equity. We've been so reliant on borrowing and debt to drive economic growth and less on savings and equity. And it's going to take time to delever. It's going to take time to bring more equity into the economic system.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
And I guess China, where do you see China's sort of growth sitting? I guess we've taken a view, just to sort of put it out and spoken a lot on this channel about it, is that, look, we think that China's been through this massive investment bubble and it's over now, and they're just trying to manage the other side of it, and they're not going to come out and with huge debt increases trying to get the whole thing going again. It's now just about how do you try to make sure that the thing doesn't fall apart as it slowly deflates. Your thoughts on China and growth?
So, I follow China really closely, and I look at it just in a few different parts. You have Chinese manufacturing, which is still the powerhouse of the world, but subject to global trade, and global trade has moderated, and Chinese manufacturing is sort of in a slump. I look at Chinese residential real estate, which is hugely challenged, and home builders are seemingly going out of business every week, and that's going to take years to work through. But hopefully, on the other end of this, there'll be a sort of a healthier residential housing market, but still a lot of transition to be had, less construction, less demand for copper and other things. From the government spending standpoint, on all the infrastructure, yeah, they way overspent, and they're going to have to pull back on that. That's not going to be the driver of growth. And then you have the Chinese consumer. And that is where I'm actually bullish on, is the Chinese consumer. And it's more of the Chinese middle class, which over the next 5 to 7 years is going to double in size. So while China has all these headwinds, it has a slowing pace of population growth. The working age population is shrinking. I still think there's this potential in the Chinese middle class that wants to live life like the rest of us, where the per capita income in China is $13,000 in US dollars. There's a lot of room for increase there. So I understand the challenges now, but you look at the Macau casinos, Chinese consumers living life again. You look at domestic travel in China, you look at restaurants, movie theaters, the Chinese consumers living life again. I mean, you got 17% of the world's population that was locked up for 3 years. Well, they've been liberated right now, and they're going to catch up on lost time. So to me, there's pockets of hope and definitely plenty of challenges. And the debt situation there, I mean, local governments that are over levered. I mean, it's like every day I come to work and there's the let's bash China story. It's just the bear story on China is just so extreme. I get it. I hear it, but I'm just trying to find some pockets of hope. And to me, the Chinese consumer is where some of that hope is.
Yeah. And look, I think I've got a lot of sympathy with that view, and I suppose we're coloured because Australia is so much of the market is resources that that's all getting the downside of the China, and the upside. There's a little bit of it, things like wines and stuff like that Australia might export, but we've actually been banned from exporting a lot of that stuff for the last little while anyway. So we're sort of in a spot where
the authoritarian situation in China, that's a whole another discussion. Unfortunately, that is crimping their growth since they've walked away from more free markets. But that's a whole nother conversation for sure.
Yeah, and so okay, so I think we've got a pretty decent, view about sort of overview about what you're looking at. So in terms of the sectors there, or actually maybe styles, investment styles, sort of value growth, quality stocks, like how are you seeing that in terms of what you're sort of trying to tilt your portfolios to at the moment?
I mean, my particular investing style is definitely old school value.
Hmm.
But that said, I'm willing to pay up for some growth. Because obviously, you don't want to get stuck in a value trap. Uh, I was talking about the Chinese consumer. We have investments in plays on China travel again. I mean, you take, for example, pre-COVID, I think it was a quarter to a third of tourists to Japan were from China. Similar ratio to Thailand. Those numbers went to zero almost. International travel out of China. The Chinese tourist in the aggregate spend $250 billion a year outside of
Yep.
China traveling, and that is just a fraction of that has come back. So I think there are ways of playing China travel and tourism. Even in the U.S., you look at concerts, for example. I mean, Live Nation, the global concert promoter. Here we are. It's May. They've sold more concert tickets in the first 5 months of 2023 than they sold in all of 2019. So it's reflective of people wanting to spend money on experiences and services, less so, of course, on goods. Speaking geographically, I think the China reopening, more so than just analyzing what it means for China, it's good for the whole Asian region. You survey any country in Asia, chances are their biggest trading partner is China. So it's good for the world to have China open again. And I think Japan's very attractive here. Parts of Australia's economy is going to definitely benefit from that. We're bullish on Singapore and own stocks there as well. Thailand, South Korea, Indonesia, all going to be beneficiaries of China's reopening and Asian growth generally. Because when you look out over the next 10 years, where's that growth going to be? And I think it's going to be Asia more so than the developed world in the US and also in Europe.
Yep. Yeah. No, I think there's it was Jared Minak who we speak to a bit. He's one is he'd prefer to be only with the China reopening, he'd prefer to own a bar in Thailand rather than an iron ore mine in Australia. I think was his pithy comment that I thought sums up.
Yeah, spending on services and less so on construction that needs steel and iron ore as that input.
Yeah. Yeah. Exactly. Okay. And so. Within the US, then, are you mainly defensive, I guess, given your outlook and which sectors? Because obviously, property is sometimes a defensive sector looked upon, and other times.
Yeah, with respect to property, we do own some REITs focused on multifamily, one office stock that caters though to the attractive markets like Dallas, Austin, Charlotte, Atlanta, Tampa, where there's population growth. Also, triple net lease properties, I think, will be okay, and also shopping centers in the U.S. But you certainly have to be careful right now investing in commercial real estate, and also just trying to be boring and owning, food-related companies and less economically sensitive stuff, and not trying to be the hero. I mean, the investing landscape is very difficult, and one thing that I personally don't like is everyone piling back into U.S. big cap tech, and sort of people trying to relive their outperformance because the artificial intelligence is the greatest new thing, which it is extremely impressive and incredible the things that it can do. But the market cap that the AI hype has added for a while is going to swamp the actual economic benefits to these companies.
Yeah, and we've taken the sort of we've been on the path to saying, look, there's charging a huge amount for this stuff actually isn't a great business model at the moment, because they actually all want more, if you're charging lots and you've only got 1 million customers and somebody else and a great product, but somebody else has got a slightly inferior product and they have 1 billion customers, then their product's going to improve because they've got more people asking questions, and so it's a bit like your browser war. Everyone just wants to give it away for free, and so
yeah, I agree. It'll be more beneficial to those that use it. Yes. Rather than those that sell it, potentially.
Yeah. And so okay, and so set those sectors in there. So Europe, your I guess your thoughts on energy costs and does that color your European sort of? I think you were negative on Europe, was it?
No, I mean Europe is sort of it's. I go back and forth. I speaking of Asia's recovery and China's reopening, I mean, Europe benefits from that. US,
Yes.
US doesn't really do much trade with China in terms of what we buy from, what we sell to them. We buy a lot from them. We don't sell as much to them. Where Europe does a lot of business with China and the rest of Asia, so they're going to benefit from that. They certainly got lucky this past winter with energy prices, but there's still just modest growth there. I think that the equities in Europe, because they've so badly lagged over the past 10 plus years, can actually sort of catch up to other markets, particularly relative to the U.S. But a lot of those markets are more, industrial focused, commodity focused, financial focused. And if there's a shift of value, if that continues relative to growth, then European markets can be okay. I see more reason to be a little bit more bearish on the European economy, less so on their equities, and there could be a differential there. But also, again, the European economy benefiting from that Asian tourist, that Chinese tour. I mean, Chinese love to visit Europe, and when then international travel really gets into gear over the next couple of quarters, Europe's going to benefit from that.
Yeah, excellent. Is there anything else you think we've missed? Any other big topics, I guess, that are on your mind in terms of?
No, I think that we're in a different investing world. We're not going back to the way things were pre-2022. We can't rely on central banks to save us in the next recession. And I just think that it's more prudent to be try not to be a hero here in the investing world.
Yes. Yeah. I think we're with you there. Have some spare cash for the other side of this. Yes.
Yeah, because when you think about a bear market, it's usually a good time to be buying stocks. So, but you need cash in order to do that.
Yeah, absolutely. And well, I guess that's probably one last sort of fitting question for the other side of this. What are the sectors you have on your shopping list, or the types of companies you've got on your shopping list for the other side that is going, well, I don't want to buy it now, but sometime over the next year or so, if the price falls far enough, these are my stocks I'm going to buy and stick in the bottom drawer.
Well, we own a bunch of those already that if they got cheaper, I would buy them. I mean, we like energy stocks. It still seems that after energy outperformance over the past now 18 months to almost 24 months, people don't really care for them. So still pretty bullish on energy stocks. Still pretty bullish on precious metals.
Sorry, actually, just to be a little bit more specific on that, is that the more the oil side or more the energy for gas and electricity production?
So we're long some of the big European energy names that have oil and gas. We do own some natural gas producers in the U.S. and also like some of the pipeline companies in North America that pay good dividends.
All of the above. Yeah.
All of the above is correct. Yes. Bullish on uranium, and there's certain value names that we like, drug stock names, drugstore names, food related stuff, just boring stuff that if they got cheaper, I'd be happy to own more of them.
Yeah. Excellent. Well, thanks a lot. That's I didn't have any other questions.
We did have a couple of technical challenges just there. Peter's logged off, so we just want to thank Peter for his time, for coming on and sharing his views from the US. So in a moment, Damien has a few more words to say, but just now we're going to go to our question of the week. So this is for viewers to have some discussion in the comment section over the coming days. The question for this week is, can we see higher inflation through recession? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And now over to you, Damo.
Yeah, so I just wanted to add a few more comments, I guess, in terms of what we're doing at Nucleus versus what we saw from Peter. So it's very interesting that we have a similar outlook in terms of the next sort of 6 months or so, in terms of credit crunch being important, thoughts around the sort of recessions and slowdown in terms of company earnings and things like that. I think that's where we start to diverge in view is that our take is that a recession and what we're seeing in terms of the early stages of defaults and things like that will be enough to knock inflation out for a 6 or 12 month period. Whether it appears on the other side of that is sort of a question which we're open to his interpretation. We're also open to interpretations that actually, if unemployment spikes higher enough and some of these other factors fall into place, and we get some of the extra capacity that's come on over the last little while, that whether we actually we see lower inflation. Having said that, a lot of that will come down to government reactions as we hit a recession. If basically government reactions are that go out and splash more cash and do similar things to what happened in the pandemic, then yes, we do think inflation will be back. If their thoughts are more around the policies we had in the 2010s and sort of it's a little bit of austerity but not too much, then our concern is that now we do go back to lower levels of inflation. And what that means for us is, I guess, the difference in outlook towards picking the stocks where we think we're looking for more of the quality side, where stocks where the margins will hold up, whereas as some of the key themes Peter was looking for in terms of looking for energy, that's not a sector that would do well under our scenario. The other one is then coming back to I think, though, the types of things he's looking for in terms of the safe and the boring stuff is absolutely on par with where we're looking at the moment. Is where can we find safe, boring stuff to hide in while we're waiting for the next side of the cycle. But yes, all illuminating certainly in terms of a similar view, but some nuances at the margins.
That almost wraps us up for today. If you enjoy our content, subscribe to our YouTube channel now, like the video, and click the bell below to make sure you don't miss out on any special episodes and future content. Also, if you know of anyone that might get some value out of today's episode, would really appreciate it if you please share it with them. We do put out a lot of other content in addition to this podcast. We have regular articles that are featured in First Links, Livewire, and we've also been written up in the AFR and the Australian. To get all this, you can subscribe to our weekly Nucleus news and investment insights at nucleuswealth.com. We do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments section below or send us an email at contact@nucleuswealth.com. For myself, Damien, Peter, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.